The year was 2007. Two engineering graduates from IIT Delhi got jobs in a company which was a dream job for many. Their office was located at Bangalore, which was emerging as the nation's IT hub, and the company was the e-commerce giant Amazon. These lads had a nice career ahead, but after working at Amazon for a short time, they had a new dream. It was bigger and better. From being employees, they wanted to be entrepreneurs. Getting inspired by the very company they were working for, that duo opened an online store from their apartment, which initially sold only books. But they expanded into other segments very fast. Those two engineers were Sachin Bansal and Binny Bansal. They were brothers, but not from the same mother. And the company they started was Flipkart, which now is Amazon's biggest competitor in the domestic market. By the year 2012, Flipkart reached a valuation of $1 billion for the first time and became India's second unicorn. Flipkart's meteoric rise was the beginning of some kind of a revolution. More and more educated people started chasing entrepreneurship, and from doing jobs, they aspired to create jobs. As a result, in the last 10 to 12 years, there have been more than 100,000 startups, and the number of unicorns crossed the 100 mark. This phase has been called Unicorn 1.0. 100 unicorns is a remarkable feat for a country which had a socialist economy until the 1990s. Now, what is expected to happen in the next phase is much bigger. Unicorn 2.0 has the potential to add more than $1 trillion to the GDP by 2030 and create more than 50 million jobs. 5 sectors are going to create disproportionate wealth, and for the first time, deep tech unicorns are expected to rise up and influence the global startup landscape. Retail investors may have a lot to gain from Unicorn 2.0. So today, we are going to have a look at some of the hot sectors of the future and also understand the real meaning of startups. Namaste and welcome to Retail Investing. This is Britain in the 1700s. The country looked very similar to any other country of the time. Most of the population was living in villages, and they almost never traveled outside their villages in their lifetimes. Their livelihood was mostly small-scale farming, and there were some skilled artisans who were making handicrafts individually. Whatever was being produced at that time had high demand, and the cost of labor was quite high, but energy was cheap because the country had an abundant supply of coal. The businessmen / the capitalists and the inventors, who by the way sometimes were the same people, had an idea of how to increase their profits. This idea was going to change not only Britain but the entire world forever. A revolution was coming. Their idea was to use the cheap coal available to run machines, and those machines would be used to produce goods. That would reduce the usage of labor and increase profits. The most famous of those machines was the steam engine. Steam power gave birth to the power loom, and soon textile became the dominant industry, creating jobs on a scale never seen before. People from their small villages flocked to the cities in thousands to work in factories. Everyone's life changed. This revolution has been called the Industrial Revolution, and it created the first big businessmen / entrepreneurs. But on the contrary, it could also be argued that the Industrial Revolution gave birth to the concept of 9-to-5 jobs with fixed salaries. Except the jobs were not for 8 hours a day. Life was very hard. Laborers had to work more than 16 hours a day. Women and little children were preferred by factory owners over men because they had smaller hands compared to men, and that's useful for working machinery with delicate threads. Before this revolution, people all around the world were independently making goods, and they themselves were taking care of marketing and sales. In a way, the attitude of problem solving, the spirit of entrepreneurship, was inbuilt in everyone. And that spirit has been emboldened by the technological advancements of the 2 centuries following the Industrial Revolution. The number of people chasing entrepreneurship now is at an all-time high. Today, we are in the age of startups. And startups can bring changes as radical as the Industrial Revolution did. There is a very famous book on startups. It's called 0 to 1, and this book has given a wonderful definition of a startup. According to this book, a startup is not a shop or a group of salesmen or a bunch of products. It is a group of people that plans to build a different future. I totally agree. Retail investing is not a company, it's a people. Wherever retail investors go, that's where retail investing stands. And the different future we plan to build is by making people capable of thinking for themselves. And that will bring down the impact of online misinformation to 0. The author of 0 to 1 was also the founder of a successful tech company. To be specific, a fintech company. So based on Peter Thiel's personal experience, building new technology has been called the defining trait of a startup. The next Steve Jobs is not going to build a computer. The next Jensen Huang is not going to build graphics cards. And the next Elon Musk is not going to build electric cars or spaceships. Copying something that already exists and improving upon it has been called going from 1 to N. But building new technology, something which does not exist yet, is called going from 0 to 1. That's the essence of the book. This concept is very much true in case of tech companies. But business innovation can be possible without building new technology. Let's see how through a case study. If we go back to 2010, the smartphone had just arrived in India. The number of smartphone users was barely 3% of the population, and mobile data was expensive, like it was gold or something, around 250 rupees for 1 gigabyte to be used for 1 month. Then in the year 2016, we all know what happened. A new company entered the telecom space and started giving free data to everyone. Out of sheer FOMO, most people switched to this new carrier. But soon after, the company started charging money for data. But still, within the next 2 years, mobile data prices were down by 95% and revenues went up 2.5 times compared to 2014 levels. Reliance Jio did not invent any new technology. They did not invent any new kind of mobile towers or spectrum bands or mobile phones. Yet, Reliance Jio literally changed the way every industry did business, because this company democratized the internet. The aftermath of Jio was that companies, big or small, had to focus on making apps because most customers would be online. Political parties and their social media mouthpieces started worrying about what was being forwarded via WhatsApp with good morning messages. And big social media companies started shifting their focus on India. Out of nowhere, India emerged as YouTube's largest market. That's what real innovation looks like. It has to redefine business for all industries, and it can be achieved with or without new technology. According to a recent report by the Confederation of Indian Industries, 5 sectors are going to add $1 trillion to the GDP in the next 5 to 6 years. Reports like these can help in a top-down investing approach in which the industries are identified first and then the companies. Our first sector is manufacturing. Its ranking in terms of contribution to the GDP by 2030 will be 3rd. Currently, it contributes only $3 to $4 billion. Now, please understand that this is not the contribution of the entire manufacturing sector to the GDP. This is the contribution of manufacturing startups. So manufacturing startups are expected to contribute $140 to $160 billion by 2030. That's a huge 50x boost. Indian manufacturing is clearly going to be a strong investing theme for the next 10 years and beyond. But whenever this sector is talked about, some people's first reaction is to bring up comparisons with China. Let's understand why such comparisons are not sensible. So in the early 1980s, China opened up their economy and adopted some capitalism. At that time, wages in the developed nations of North America and Europe were already very high. Western companies were not happy with their profits. China, being a low-income country at that time, had very cheap labor. On top of that, they also devalued their currency, which made Chinese imports very cheap for Western nations. As a result, the big multinational companies shifted their manufacturing to China en masse. But today, wages in China are not low anymore. Add geopolitics to that, and the result is that many companies are taking their manufacturing out of China. For example, Apple, which is a $3 trillion company, started manufacturing their less expensive smartphones in India last year. And from this year, their most expensive and premium smartphones will also be manufactured in India. But that does not mean that India or any other country needs to build as much manufacturing infrastructure as China. You see, when it comes to trade, the world is globalized, and China is already supplying most of the world's manufacturing demands. If India builds the same amount of manufacturing infrastructure, the supply of manufactured goods will become twice the demand. That is going to affect the prices and probably create an economic crisis. China is likely to remain the top manufacturing economy in the world, but a significant volume of high-quality manufacturing will be coming out of India. As a matter of fact, something big has already started happening. An organization representing the electronics industry called the India Cellular and Electronics Association is creating an Indo-American Electronics Task Force. The goal of this task force is to increase Indo-US electronics trade by 8-fold over the next decade and also take India's overall electronics exports to the world up to $300 billion by the financial year 2026. This is going to create some big investing and business opportunities in the sector. And for the first time, deep tech is expected to rise up in India. So during Unicorn 1.0, we saw the success of software startups like TCS and Infosys. These are very simple businesses which make money by providing certain services to clients globally and domestically. From an investing point of view, these have been excellent businesses which created lots of wealth for retail investors since 2010. But these companies are not into innovating. Hence, they cannot be called tech companies. Unicorn 2.0 is going to change that. There will be deep tech companies whose defining trait will be technological innovation. A company can be called deep tech if it can provide solutions to scientific or technological challenges. Semiconductor innovations, recycling of batteries, green hydrogen production, space. These are some of the sectors in which deep tech startups have already emerged. A very good example is the space sector. ISRO, which is a government organization, was the monopoly in the space sector. It made a name for itself by successfully launching satellite after satellite for India and foreign nations. There has been enough skilled talent inside ISRO which did significant research and development. Now the government has decided to open up the space sector to private players to encourage entrepreneurship. Startup founders are being given access to ISRO's facilities. As a result, a few space startups have already emerged. A company named Skyroot, founded by former ISRO scientists, is getting attention from VCs. It has already launched a rocket into space. Deep tech companies today are in a similar situation in which the software companies were in 2010, about to take off and create wealth for decades. Our second sector is software as a service and digital services, presently contributing $6 to $8 billion to the GDP, and by 2030, startups from this segment are going to contribute $40 to $60 billion, close to a 10-fold increase, and that will take this segment's ranking to 5th. So software as a service is a type of cloud computing. All the big businesses use SaaS to deliver their services to the consumers in a cost-effective way. Streaming services like Netflix are products of SaaS. Our third sector is retail and e-commerce. This segment presently contributes $75 to $80 billion to the GDP, and by 2030, its contribution will be $380 to $400 billion, and it is going to secure the first rank. The boom of e-commerce is already visible. When Flipkart started, it was pretty much the sole player. And now it's a very different world with many big players and more new players are entering the fray. Software as a service and e-commerce are the two segments from which Indian startups have the potential to emerge as a global leaders. Now a company has to meet certain criteria before it can be called a global leader. Firstly, it has to be among the top 10 companies in this segment by revenue. And secondly, it needs to have a market leadership in a minimum of 2 large markets outside India. Our fourth sector is fintech. It presently contributes $8 to $9 billion to the GDP, and by 2030, the contribution will be $65 to $75 billion, securing the fourth rank. The rise of fintech in India is quite exciting. The story goes something like this. One fine evening in November 2016, the Prime Minister came live on national television and he announced that the 500 and the 1000 rupee notes could no longer be used as currency. After that, doing cash transactions became quite difficult for some time. Fintech companies seized that opportunity and there was a sudden explosion of these companies. But if people did not have bank accounts in 2016, the rise of fintech would not have been possible. And as a matter of fact, very few people had access to banking services as of 2014. In that year itself, after the elections, a massive financial inclusion program was started. Millions of bank accounts were opened in no time. Even a Guinness World Record was set. Initially, those bank accounts had zero balance. The scheme was criticized. But today, even fruits and vegetable sellers from remote areas are doing business using UPI. It has reached every corner of the country. However, the growth story of fintech is not over. It is estimated that by 2030, 90 to 100% of households will be using digital payments. That is a growth of 31% CAGR from the present. Financial inclusion, which is basically having access to banking services and credit, should be declared a human right. And fintech has a big role to play in financial inclusion. But we should also understand that when 90 to 100% of 1.5 billion people start using digital payments, many of them will be vulnerable to financial scams. It is the duty of governments at all levels, union and states, to make it impossible to do financial scams in this country. Banks and fintech companies themselves may help by using technology, by introducing features like tracking and reversing specific large payments within the first 24 hours. Otherwise, there could be unicorns coming out of the scam industry as well. Our fifth segment includes the sectors of agriculture, health tech, travel and mobility, telecom and entertainment, and education. These sectors presently contribute $40 to $45 billion to the GDP, and by 2030, they are going to be contributing $260 to $270 billion, securing the second rank. Rise of all these sectors is interdependent on other sectors. For example, e-commerce cannot become so big without the rise of the logistics sector. And how can the logistics sector work without good highways and expressways? Flipkart and Amazon can deliver items within 24 hours, even in small towns and cities. Thanks to the highways and the infrastructure initiatives, the economy is ready for Unicorn 2.0. When the Industrial Revolution was going on in Britain for 2 centuries, India remained a colony. Opportunities for Indians in terms of both businesses and jobs were very few. Small parts of the population, around 10 to 15%, grabbed those opportunities, and the other 85% remained backward. Pro-business policies can change all of that. The impact of startups goes beyond just creating jobs and adding to the GDP. Startups can bring positive changes to society and empower the most backward of communities. Because today, there is no more license Raj, and anybody can start a business. Business income has lots of advantages over salaried income, notably with taxes. It is a fact that businessmen pay lower taxes in relation to their business income when compared to salaried individuals. It is just a case of very high reward for taking high risk. Owning businesses will be the key to creating wealth in the future, but not everyone has the expertise to start a business. They can always learn, but investing in stocks is the same as partly owning businesses. When IPOs of these future unicorns start getting listed on the stock market, there will be opportunities for owning businesses. But retail investors need to be cautious of the valuations. And aspiring entrepreneurs need to understand that getting a valuation of $1 billion is not as important as building a business that can positively impact the lives of 1 billion people.